Well, the talk of the market last week was the wild swings in Bitcoin prices, which dropped 30% and then gained 30% within the space of just a few hours last Wednesday. The world's first cryptocurrency hit a low of about 30,000 US dollars before recovering some ground to be trading around the previous low of 40,000 US dollars. That level now looks to be a strong point of resistance, and Bitcoin will need to make a convincing break above it and move back above its 200-day moving average if the bull run over the last 12 months is to continue. The crypto turmoil really began back on May 13th with Tesla CEO Elon Musk tweeting that the company would no longer be accepting Bitcoin as a payment method because of climate concerns associated with the token. Analysts estimate that the Bitcoin mining process whereby Bitcoin trades are authenticated uses approximately the same amount of electricity as Sweden. Bitcoin and other cryptocurrencies have been in vogue since the start of the COVID-19 pandemic and the start of rapid money printing that central banks have been doing to try to stimulate our way out of recession. Bitcoin bulls are concerned that all of the money printing that is going on is devaluing national currencies. That is, if there are more dollars and the same or fewer goods and services being produced, the dollars are worth less. Crypto optimists see owning Bitcoin, which has a fixed supply and exists outside the reach of banks and governments, as a hedge against inflation. Critics see cryptocurrencies as highly speculative, unregulated investments that cannot seriously be considered a safe haven asset due to the massive price volatility and the ability of a few whales, like Elon Musk, to manipulate prices in the market with just a single tweet. In other market news, we saw the release of the April unemployment figures for Australia last Thursday. The numbers were a bit of a nasty shock, showing the economy shed 30,000 jobs for the month, and that was against expectations of a gain of about 20,000 positions. The job losses were overwhelmingly amongst part-time jobs, and despite the negative number, we actually saw the unemployment rate tick slightly lower to 5.5%. That's because the number of Australians in the labour force or looking for work actually fell. Something else that caught my eye last week is that we seem to now be exiting the days of record low fixed rates for home loans. Commonwealth Bank last week increased its 3 and 4 year fixed rates for owner-occupiers by between 5 and 10 basis points, which follows recent increases from Westpac, NAB and a range of smaller lenders. The increases come as we draw closer to the termination date for the RBA's Term Funding Facility, which provides 3-year debt to the banks at a very cheap 0.1%. That facility is due to finish at the end of June, and from that date forward, the banks will have to find other ways to fund those loans, which is probably the main reason why we are seeing these increases in mortgage rates. The rate rises may also help to explain the recent downward trend in auction clearance rates, which have been falling for about 4 or 5 weeks now. Real estate markets remain fairly hot across the nation, but the slight cool down will come as a welcome reprieve for discouraged home buyers. And that's finance.
Thanks, Ben. That could certainly offer some breathing room for those looking to buy.